This can't be avoided. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, another Wall Street analyst is predicting that the economy will slip into a recession in the second half this year, and that is completely unavoidable. We'll take a look at why she says that and if we think that she's right or wrong. And with the Fed scheduled to announce their monetary policy decision tomorrow, we're going to look at why the Fed continues to embark on what will be considered one of the biggest policy mistakes in monetary history. The evidence just continues to mount. And with that, we also have further evidence that the likelihood the economy will be in a recession this year is increasing. Let's head over where we picked today's story up with the headline that Wall Street economist says recession in 2023 will look like the biggest crisis of the 1970s. This from Fox News. People are often too focused on 2008 and 2020. This is more like 1973, 74, and 2021, according to Piper Sandler chief global economist Nancy Lazar. Lazar predicted feeling the full impact of recession in the second half of 2023 as lag effects from the Federal Reserve's rate hikes take hold. Now, I want to address this early on because there's a lot of people that say, hey, the economy today is just like it was in the 1970s. And we're going to look at what that means on a chart here in a moment. And then we're going to address this whole issue with this Fed rate hike lag and what it means to the economy. But what I want you to understand is there's a big difference between the 1970s and the economy today. And the big difference was we were in the early stages of this dollar being a global reserve currency. And as part of that, what you need to do is export dollars to the rest of the world. But you have to remember, the global economy did not look like it did today. In fact, Americans tended to buy American-made products. Products made outside the country were generally considered substandard. So if you look at the 1970s, there really wasn't a mechanism for these dollars to escape the U.S. Instead, they got trapped in our domestic economy, and that led to inflation. Yes, now I know there were other reasons for it, but when you start to see what happens over time, as the global economy starts to become a manufacturing base and we can export dollars, what we note is that inflation pressures come down. Now, as far as the great financial crisis, and we look at 2008 and 2009, that was an issue of one simple reason. We had too much debt, the economy slowed, and somebody popped the bubble. And that's a big difference between the two. So the question we have to look at today is, are we in a case like the 1970s where dollars are getting trapped inside the U.S. and domestic inflation is here to stay? Or do we have a massive debt bubble that if the economy slows too much is likely to get popped? Let's take a look at this chart here, and we're going to go back to the 1970s. Here you see the Consumer Price Index shown on a year-over-year rate of change in blue, this against gross domestic product. So what's notable here is even as inflation increased, we saw that economic activity and output also increased. And we can note today that there's virtually nobody that actually is predicting that inflation will continue to go higher, and that will bring an economic boom with it. Nobody's really saying that, and again, it's a good reason for it because the economy, the global economy changed once we restart the ability to export dollars. Now let's look at where we're referring to today. They're talking about the kind of recent data here. And you can see the GDP is coming down with inflation. And we can note that that happens again quite a bit, whereas before we didn't see it quite as much. But now we know that inflation is strongly linked to output, which suggests that inflation may be more of a supply chain issue and a demand issue than anything else. Now let's talk about this federal funds rate and this lag behind it, because there's this big issue of if the Fed raises rates, it hits the economy with these long and variable lags. But yet, after decades and decades of monetary policy and the Fed employing more PhD economists than anyone else on this planet, we can't even come up with a reasonable estimation because we've never hear any Fed chief say, hey, we're pretty sure it's somewhere around this many months. And after now, we should know, is it 6 months, 12 months, 18 months, 24 months? And why? Well, I want you to see that that really isn't the case, but yet many people believe it, including the Fed. And here you can see on this chart the consumer price index still shown in blue against the federal funds rate. And we can note that the Fed has cut rates in advance of inflation coming down. In fact, that's rather common that the Fed begins to cut before inflation actually cools off. So if the issue here is that that rate hikes hit the economy with a lag, then why is the Fed cutting rates ahead of it? It doesn't make any sense. So the question here that we need to address is the Fed completely powerless, which I believe this is the case that our chief strategist Jeff Snyder and I made not last weekend, but the weekend before on his channel. And in case we can, go back and watch it, because you'll see we actually think that the Fed is rather powerless here, because maybe the real story is that inflation takes off and wages don't increase fast enough, and then all of a sudden the economy starts to slow, and that's why you see inflation come down. While the Fed is targeting the PCE headline figure as it tries to wrestle consumer prices back to 2%, Fed Chair Powell previously told reporters that the core data is actually a better indicator of inflation. Both the core and headline numbers point to inflation that's running well above the Fed's 2% target, a troubling sign as the central bank is already hiking rates at the fastest pace in decades. Lazar argued it takes about 1 year for changes in the funds rate to have a negative impact on the economy, and yet there's really no evidence to suggest that that's the case at all. Not even the Fed knows. The issue here is what happens a year later after inflation takes off is that consumers can't afford it. And that's the real issue here. Let's take a look at this chart, which is the consumer price against the personal consumption expenditures. We're not showing the core, which is excluding food and energy, but what we can see is personal consumption expenditures in red are just a noisier version of the consumer price index, which gets smoothed out. And yes, while indeed both of them are running above the Fed's 2% target, we're going to look at data later on in the show to suggest why this number is going to come down in a big way, and that's going to put the Fed in an awkward position where they're going to have to cut when they don't want to. We think there'll be a further stalling out in the second quarter and then an outright decline in the back half of the year, according to Lazar, because you had first a global tightening cycle in 2021, the lagged effects that hit the U.S. economy with our multinational economy. Second, oil prices surged in 2021, and third, bond yields rose significantly. So what slowed down last year were those three metrics. Going into this year, the lagged effects of the Fed tightening cycle is reflected in money supply now declining. But what I want to point out here is perhaps some of the issues. We look at this article, and what does she say? The lagged effects. Well, she mentions oil prices. Well, that feeds right back into inflation. So if consumers can't afford oil prices that are rising faster than their wages, that means their energy consumption goes up. Their spending on other things has to go down. She mentions interest rates. Well, what do we note about interest rates? People tend to borrow more when interest rates are low than high. And that is key here, because over time, as rates go up, consumers tend to prioritize paying down their debt rather than taking on new debt. And of course, she mentions the global tightening cycle, and that could just be easily summed up as the fact, well, we don't have a whole bunch of fiscal stimulus going around the world anymore. And so likely the global economy has to digest that and has to come back down. So all of these things that we're looking at here have really nothing to do with the Fed. When it comes to the labor sector, Lazar pointed out dark clouds are hovering over the unemployment numbers, and that increase in December was quite interesting in the employment backdrop, as the unemployment rate is still sitting at 3.5%. It's telling us that the consumer does see some dark clouds on the horizon. They realize potentially they took their savings rate way down too far, below 3%, and now they're maybe getting a little bit more concerned. But of course, we've talked about on this show before that the issue here with the labor market is that employers just hired a whole bunch of people. They've trained a whole bunch of them, and they don't want to let them go right away because they don't want to go through that process again. They too are hoping that things for the economy will turn around. If they don't in the first part of this year, we will look to see those layoffs increase. And so that's what I think the issue here is. She also mentions the savings rate, which I want to point out here is something that doesn't make sense. What you see is when consumers are confident about the economy, well, then granted, they start saving more, they actually spend more. But when they can't afford rising prices, which is a key point I'm trying to make on the show today, what do? They spend down their savings savings to the point where when they see their savings low enough, they then cut their spending. They again draw down their savings and hope their wages go up fast enough. If it doesn't happen, then their spending gets cut, and we can see that on this next chart. Here we can note the consumer price index for all urban consumers in blue against the personal savings rate. And sure enough, what do we see when inflation comes down? The economy is doing well. The savings rate goes up. We can note in periods when consumer prices tend to go up, we eventually see the savings rate start to plateau. We see inflation going up here, savings rate coming down. We see again this inflation starting to trend higher here, the savings rate plateau, and now you see the CPI rise rapidly, and of course the savings rate comes down. It's a very bumpy roller coaster, she says, but the roller coaster is headed down. But here in January, we think things could get a little bit better. We don't see a recession until the back half of 2023. We think the first half is actually going to be muddling along, which I agree, because what I see here is everybody's going to just stop and see, does the consumer keep spending? Until we have data that shows otherwise, we have to assume that at some level they will. If they don't, then that back half story comes into play in a big, big way. If they do, then perhaps the Fed gets their soft landing that they want. Now, on Thursday, I'm scheduling to raise the price on CTA-Timer Pro. If you want to know why the markets just don't sell off, even though everyone remains bearish, we've talked about this before. It's the machine positioning. They're buying more. There's a momentum-based market. Again, it's $20. The price is going up, and that will follow the Fed meeting on Wednesday, as the Fed points towards a pause in May once hikes have time to set in. The argument is just whether you should pause after 3 months of data or pause after 6 months of data, says Waller, and he is a member of the FOMC board. From the risk management side, I need 6 months of data, not 3. And Vice Chair Lael Brainerd, speaking a day before Waller, also pointed to declines in 3 and 6 month measures of inflation, leading us to wonder now, what is it they're afraid of that they need more time to see? Mindful of how they got head faked in 2021 when prices cooled and then heated back up, officials have stressed the need to see a few more months of similar soft readings to convince them the gauges are on a meaningful decline back to their 2% target, which I'll make the case is already on their way there. But let's take a look at what the Fed is worried about first. Here you can see in 2021, this is what they claim was the problem, but they can't see it because the yield curve is predicting inflation is coming down. Now we're showing the 10-year 3-month yield curve in red, and we note the periods where it's below the horizontal black line, it shows inverted and rises. Now it doesn't mean you can't see inflation go up again. Here you see in blue, it just means at some point it's going to come down in a big way. We see that throughout history, over and over again. But what the Fed is completely missing is that inflation is largely a function of gasoline prices, which are running around a 0% year-over-year rate of change, which coincides just about perfectly with a 2.5% CPI, which would be right near where the Fed's target is. So I want you to see they're worried about something they can't see because there's a real simple data series. If they looked at it, they would actually know what is coming. And now we'll head over to Dallas to see signs that perhaps that second half recession is in the cards. Recession is on the way, according to Dallas Fed, shows factory activity slumping for the 9th straight month. And sure enough, here you can see that this is a fairly serious downturn, only now going back to the great financial crisis where Dallas manufacturing was in a major downturn. We could start to see similarities of what looked like a global recession that began to happen in 2015 until China bailed out the world. But when we look at this general business activity of Dallas, it's really a function of crude oil prices. So if things want to turn around in Dallas, well, look to see if crude oil bottoms here. If it does, the manufacturing activity in Dallas will head higher. If it doesn't, it heads lower. We'll look for things to get worse in Dallas, along with more layoffs. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.